Welcome to the Opening Bell Report.
Today, we are fueling up. And I don't just mean grabbing a quick caffeine fix to get through your morning commute.
Though that definitely helps.
Oh, absolutely, it helps. But I'm talking about the absolute war zone that is the modern coffee industry. Because, you look around and you see the giants, Starbucks, the Dunkins, they are everywhere.
They were essentially the Roman Empire of caffeine. They've been very comfortable on that throne for decades.
Exactly. But as history teaches us, empires eventually get lazy. Or, well, at least they get slow. And that is where today's topic comes in. We are looking at the Challenger.
In this whole David versus Goliath story.
Right. If David was wearing neon sunglasses and blasting EDM music, we are talking about Dutch Bros. Specifically, we're digging into a new analysis report titled The Dutch Bros Doctrine, Mastering Profitable Hypergrowth. And let me tell you, doctrine feels like the right word here.
It really does. Because this isn't just a standard quarterly update. It feels like a manifesto for the company's future.
Yeah, and what's fascinating about this particular analysis report is that it completely challenges the one thing everyone thought they knew about Dutch Bros. Because for years, the knock on this company ticker symbol, BROS, was that it was just a massive cash furnace.
Right. You know the narrative. Grow at all costs, open 1 million stores, and we'll figure out how to actually make money later.
Exactly. It's that classic Silicon Valley playbook, but just applied to drive-through coffee shops.
Right, the growth at any cost model. But looking at the new data presented in the analysis report, that old narrative seems, frankly, dead.
Completely dead. I mean, The core thesis of this report is that Dutch Bros has pulled off a pivot that very few companies ever managed to do.
They've shifted from being a pure growth story to a highly profitable, self-funding growth machine.
And the timing of that couldn't be better. Because while Dutch Bros is accelerating, you look at those legacy giants we mentioned earlier.
They're struggling.
Seriously struggling. Their foot traffic is flat, their margins are getting squeezed by inflation, and let's be honest, their customers are getting grumpy.
It creates this incredible contrast for you as an observer. You have the old guard desperately trying to defend the castle, and then you have Dutch Bros essentially storming the gates.
It's wild. But I want to play the skeptic for a second here. Because when I hear profitable hypergrowth, that sounds like a marketing buzzword.
It sounds like a slide deck title.
Yeah, exactly. It sounds like something a CEO puts on a presentation just to prop up the stock price.
I was highly skeptical too. I mean, until I actually dug into the Q4 numbers in the analysis report.
Okay, let's unpack that then. Because I looked at the headline numbers in this report, and I genuinely thought there was a typo.
You're talking about the massive earnings beat.
I am. Usually, in this sector, the restaurant, retail, food space, if a company beats Wall Street estimates by a penny, maybe 2 pennies, it's a huge deal. They pop the champagne.
Right, it's a huge victory lap for management.
But Dutch Bros didn't just edge out the estimates.
No, not at all. So the consensus estimate from all the top analysts, the people whose literal job it is to predict these things, was that Dutch Bros would earn 9 cents per share. 9 cents.
9 cents. And what did they actually drop in Q4?
Adjusted earnings per share hit 17 cents. 17 cents.
Wow.
Yeah, they didn't just beat the estimate, they nearly doubled it. They completely obliterated the Wall Street consensus.
And on the revenue side, the report shows they pulled in $443.6 million for the quarter.
Which is a 29.4% increase year over year.
Nearly 30% growth in this economy, with inflation where it is.
Exactly. Context is everything here. If you look at the broader quick service restaurant industry, your fast food, your drive-thrus, most of those companies are fighting tooth and nail for 3 or 4% growth.
Right. They're high-fiving in the boardroom if they hit 5%.
And Dutch Bros is sitting there at nearly 30%. It is an outlier of massive proportions.
But hold on, let me push back on the why here, because we have all seen this trick before in the retail space.
You mean the pricing trick?
Yes. A company raises their prices by 10% because of quote-unquote inflation. Their top-line revenue goes up, but they actually served fewer customers. Is that what's happening here? Are they just charging you $8 for a Rebel energy drink instead of $6?
That is the single most critical question you can ask when looking at this report. It's the literal difference between fake growth and real organic demand.
So what does the analysis report say about it?
It digs into this specifically. They look at system-wide same-shop sales, which grew by a very healthy 7.7%.
Okay, so that accounts for the stores that were already open, not just the new ones. But again, does that just mean higher prices?
Here is the real aha metric from the report. Transaction volume actually increased by 5.4%.
Actual transactions, so distinct orders at the window.
Yes, that means 5.4% more transactions. More cars pulling into the lane, more people walking up to the window.
That is the real deal then.
It is. While their legacy competitors are seeing traffic decline, literally fewer human beings visiting their stores, Dutch Bros is actively taking direct market share. They are bringing net new people into their ecosystem.
That is wild to me because you turn on the news and we keep hearing about the tightening consumer wallet. People are cutting back on discretionary spending across the board.
Right, the macro environment is supposed to be terrible for this.
Exactly. You'd think a $6 iced coffee would be the very first thing to get cut from the family budget. Why is Dutch Bros seeing volume growth when everyone else is seeing the opposite?
The analysis report points to something economists call the lipstick effect.
The lipstick effect. Break that down for me.
It's an economic theory that says when people can't afford big-ticket luxuries like a new car or a fancy European vacation, they don't stop spending on fun things entirely. They just pivot to affordable luxuries.
Small treats.
Precisely. A really sugary, highly caffeinated drink with a fun name is a relatively cheap way to get a quick dopamine hit. And Dutch Bros has positioned itself perfectly as that fun, daily escape.
It's not just coffee, it's an experience.
Exactly.
Which actually leads us perfectly to the next part of this analysis report. And honestly, this was the part that surprised me the most. We need to talk about the margin miracle.
Oh, this is where the business nerds really get excited. Because growing revenue is fantastic, but if you lose money on every single cup you sell...
You're just sprinting toward bankruptcy.
Exactly, you're just failing faster.
And historically, based on the report, that was the big fear with Dutch Bros. Back in 2021 and 2022, they were building so incredibly fast, construction and labor were getting expensive, and their net margins were negative. They were actively penalized by the market for losing money to fund their growth.
Right. But the analysis report details a massive turnaround on that front. For the full fiscal year, their net profit margin reached a very healthy 4.9%.
Which is a solid baseline.
But look at the trend line. In Q4 specifically, it accelerated to roughly 6.5%.
A 6.5% net margin. For a drive-through coffee shop, that seems really high.
It's exceptionally strong. And the report credits a trifecta of operational wins for this margin expansion. I want to drill down on the first one because it is entirely unique to the Dutch Bros model.
The labor model, the runners.
Yes, the baristas. If you drive past a standard legacy coffee chain, you pull up and you talk to a little plastic speaker box. It's impersonal, you can't hear them, and often it's just slow.
Oh, it's brutal sometimes. But if you drive past a Dutch Bros, you have teenagers literally running out to your car with tablets. They take your order before you even get close to the actual building.
It looks chaotic from the street.
I'll be honest, sometimes I pull up and I'm like, who are all these people swarming my car?
Yeah.
But the line moves incredibly fast.
That's the organized chaos the report talks about. It argues this is a massive efficiency hack.
Yeah.
By having those runners stack the line-taking orders 10, maybe 15 cars back, the kitchen inside can start building those drinks way earlier.
So by the time you actually roll up to the window, the drink is already done and waiting for you.
Exactly. That speed drastically increases throughput. And in this business, more cars per hour equals more revenue per labor hour. That is what drives that margin up to 6.5%.
It also completely kills the line anxiety. You know that feeling when you're stuck between two cars in a drive-thru you haven't ordered yet and you feel like you've been forgotten?
The worst feeling.
But when a human walks right up to your window in the first 10 seconds, you feel served. You're locked in. You aren't going to pull out of the line and drive away.
Precisely. It's a psychological moat around their business. Now, the second factor in that trifecta is pricing. They make strategic adjustments that customers actually absorbed well. But the third factor is crucial. It's loyalty.
The app. Now, I feel like literally every company on Earth has an app now. Why does the report say theirs is so special?
Because of how they use gamification and the data it provides. The analysis report mentions a massive surge in app-based transactions over the last year.
And app customers are generally more valuable, right?
Immensely more valuable. These customers are sticky. Once you're chasing those digital stickers or points for a free drink, you actively stop going to the competitor down the street.
It becomes a habit.
And more importantly, app customers just spend more money. It is so much easier to customize a drink, add an extra shot of espresso, or throw in a muffin top when you're just tapping a screen versus saying it out loud to a person.
The upsell is totally frictionless.
Exactly. And all of this, the runners, the smart pricing, the app, flows into the final metric in this section, which I genuinely think is the mic drop number for the entire analysis report.
Let's hear it.
Operating cash flow.
Okay, so this is the cash the business actually generates from its day-to-day operations. Not fancy accounting tricks, but literal cash entering the corporate bank account.
Correct. The report highlights that their operating cash flow is now sitting at 18.0% of sales.
18%.
18%. To put that in perspective for you, that puts Dutch Bros in the absolute elite category of the restaurant world. That matches the prime historical years of the biggest heavyweights in the industry.
So for every dollar they sell in coffee and energy drinks, 18 cents is turning into pure operating cash flow.
It is a cash printing machine at this point.
And that changes the entire trajectory of their future, because if you have your own cash, you don't need to go begging Wall Street for it.
Exactly. And that is the perfect transition to the third part of this deep dive.
Yeah.
Because Dutch Bros has a very, very ambitious roadmap ahead.
The 2029 master plan. The analysis report makes a huge deal out of this. Management's stated goal is to operate exactly 2,029 shops by the year 2029.
It's a brilliant marketing number, obviously. But operationally speaking, it is an absolute mountain to climb.
Where are they at right now? Somewhere around 900.
They crossed the 1,000 mark recently, actually. They're pushing towards 1,100 rapidly. But the near-term guidance for 2026 is what's really telling here. They are forecasting 191 new shop openings in 2026 alone.
181 stores in 1 year. That is a new shop opening roughly every 2 days.
The velocity is insane.
It is. But here is my worry, and I think any rational person looking at this map would ask this. Aren't they eventually going to run out of room? Or worse, start cannibalizing their own sales? If you put a Dutch Bros on every single corner, you're eventually just stealing customers from your own stores.
That's a very valid fear. In the industry, that's known as sales transfer. But the analysis report offers a strong counter-argument to this.
Which is?
First, the sheer geography. They're still massively underpenetrated on the East Coast and in the Midwest. They started in Oregon, and they are moving west to east.
So there are entire states right now that have 0 Dutch Bros locations.
Exactly. The white space on the map is still huge. But even in their existing mature markets, they use a real estate strategy called fortressing.
Fortressing, like building a defensive castle.
Sort of, yeah. They intentionally build new stores very close to existing high-performing stores, specifically to shorten the drive-through lines.
Wait, they want to siphon their own traffic?
Yes. Because yes, the individual store's daily sales might dip slightly, but the overall market share in that zip code goes up.
Oh, I get it. Because the people who used to just drive past the old store because the line was wrapped around the building, now they actually stop at the new one.
Exactly. They are capturing the impatient dollar that they were previously losing to competitors.
That is fascinating. So they are willing to trade a little bit of per-store efficiency for total dominance of a neighborhood.
Right. And because of that 18% cash flow we just talked about, they can actually afford to do it. This ties directly into the self-funding model the report highlights.
Okay, let's break down this self-funding concept. Because usually when a brand grows this fast, they are constantly issuing new shares of stock or taking out massive high-interest loans.
Right. Let's use an analogy. Imagine you own a lemonade stand. Usually, to afford to build a second stand across town, you have to sell half your business to your neighbor just to get the money for the lumber.
Which means I own less of my own company. Shareholder dilution.
Exactly. It's toxic.
Nobody likes dilution. It's literally like watering down my morning espresso.
That is the perfect way to look at it.
Yeah.
But Dutch Bros is generating so much cash from their existing stands, thanks to that 18% margin, that they can buy the lumber for the new stands with their own money.
They don't need the neighbor's money at all.
Exactly. The report estimates their capital expenditures for 2026 will be somewhere between $270 million and $290 million. And because of their massive cash flow, they can fund the vast majority of that internally. No toxic dilution required.
That is the holy grail for growth investors. Growing at warp speed without watering down the stock. It almost sounds too good to be true.
Well, there is a catch.
Which brings us to the elephant in the room. The price tag.
The valuation.
Yeah, the valuation. The analysis report notes that Dutch Bros has a trailing PE ratio that's price to earnings of 79.45.
It's a big number.
It's a massive number.
Oh.
Now, I'm looking at this and my wallet is instinctively trembling. The average reliable S&P 500 company trades at, what, 20 times earnings? Maybe 25 on a good day.
Right around there, yes.
And Dutch Bros is trading at nearly 80. That is astronomically expensive. Why on earth would you pay 80 times earnings for a company that sells coffee?
It is the ultimate sticker shock moment. If you are a traditional value investor, you see 80 times earnings and you run screaming for the hills. You go buy a boring utility company instead.
Right.
But the perspective in the analysis report argues that just looking at the PE is deceptive. You actually have to look at the PEG ratio.
The price to earnings to growth ratio. Break that down for us.
So you aren't just paying for the earnings they have today. You're paying for the incredible speed of their earnings growth. The E in that PE ratio, the actual profit, grew by 88% year over year.
88% earnings growth in a single year.
Yes. So the denominator of that equation is catching up to the stock price incredibly fast.
That makes sense.
The report points out that a year ago, the multiple was actually over 150x. It has effectively been cut in half.
Yeah.
Not because the stock price crashed, but because the underlying profits exploded upward.
So the company is essentially growing into its own valuation.
Exactly. The analysis report uses a great comparison here. It's like choosing between buying a reliable family sedan and a Formula One race car.
Okay, I like this.
If you buy stock in a legacy competitor, you're paying a sedan price. It's safe, it's a reasonable multiple, but it's only going 65 miles per hour. You're getting 3 or 4% growth.
And with Dutch Bros,
You are paying for the Formula One car. It is wildly expensive up front. It could be volatile, but it is accelerating at 150 miles per hour.
Right.
The report argues that for a company growing earnings at 88% and revenue at nearly 30%, a 79x multiple is actually justifiable. They call it a compelling growth to valuation setup.
Justifiable, sure. But it's still inherently risky, isn't it?
Oh, incredibly risky. If they miss a single quarterly earnings report, if that transaction growth slows down from 5% to, say, flat, the stock will get absolutely hammered.
Because all that future growth is already baked into the price today.
Exactly. You are paying a premium for perfection.
That's the catch with these hypergrowth stories. When you're priced for perfection, you literally have to execute perfectly. Every single quarter, no excuses.
And to their credit, so far, they have been executing perfectly.
So let's zoom out for a second and look at the whole battlefield here. We've got the Q4 blowout, which proves the customer demand is very real and growing.
Yep.
We've got the margin miracle, proving they figured out how to actually make real money on that massive demand. We've got the 2029 master plan, showing they have the internal cash machine to fund their own nationwide expansion.
And we have a valuation that, while sky high, is arguably supported by the sheer velocity of their bottom line growth.
It really is a pivotal moment for the brand. The report calls it their golden window.
It does. They've cracked the code on profitable scaling.
But, as we wrap this up, I want to leave everyone listening with something to chew on. Because we have seen hot restaurant brands before. We saw Krispy Kreme in the early 2000s. We saw Chipotle in its early expansion days.
History is absolutely littered with the quote-unquote next big thing.
Right, and right now, Dutch Bros is the cool, scrappy underdog. They are the anti-establishment coffee choice. Their culture is high energy, it's loud, it's young. You've got teenagers fist-bumping you through the car window.
It's a very specific vibe.
But they are aggressively marching toward 2,000 stores. And then probably 3,000. Then 4,000.
And that raises the ultimate existential question for the company.
Exactly. At what point did they become the legacy giant? At what point does that rebellious, chaotic energy just become a sterilized corporate policy?
It's the paradox of scale. To
Right.
grow that massive, you have to systematize everything. You have to have strict rules and operating procedures.
But rules are the enemy of the cool factor.
Completely. Can Dutch Bros maintain that authentic Broista culture, that genuine, chaotic human connection, when they have 5,000 stores and are being managed by Wall Street spreadsheets?
Because if they lose that distinct culture, they aren't special anymore. They just become another boring drive-through selling expensive sugar water.
And if that happens, that premium 80 times valuation evaporates overnight.
That is the multi-billion-dollar question. Can hypergrowth exist forever, or is this just a beautiful, fleeting moment? We will be watching every single earnings report to see how they navigate it.
It's going to be a fascinating ride.
It really is. Well, that is a wrap for today's deep dive into the Dutch Bros analysis report. Thanks for hanging out with us, and seriously, go get yourself some caffeine. You're going to need it.
Don't forget to like, share, and subscribe for more.